What is up, everybody? We have a new topic, new subject matter for us to talk about. What is happening with Japan's bond market? I am here to go over key details. Let's see what's going on, and let's continue to get all of our learning education in one place. Okay. All right, let's see here. So we have Daniel. I'm going to go ahead and, was this Lacali? If I said it wrong, I'm so sorry. So he says, Japanese bond yields remind you that consistently increasing spending and debt leads to stagnation and bond rot. This is via Bloomberg. And the photo, of course, we're obviously going to, have this up for everyone on the screen. So let's talk a little more about it. I actually was able to dig up a little bit more, research. So let me try to get here. This is the best examples that I've gotten to help us understand it. Okay. So what happened in the Japanese bond market and why it matters? Yields have exploded to levels unseen in decades. A 20-year JGB is at 2.65%, highest since 1999. A 30-year is at 3.2%, all-time high, and a 10-year JGB is at 1.6%, highest since 2008. The immediate trigger is next Sunday's upper house election, July 20th. The market's now priced in a scenario where the ruling coalition loses seats and every party ties to woo voters with tax cuts and spending pledges. More spending, more bond issuance, meaning investors are demanding a more higher yield. The policy backdrop has flipped from BOJ is a whale to you're on your own. Since March of 2024, the Bank of Japan scrapped negative rates, ended yield curve control, and is selling, not buying bonds, already shrinking its balance sheet by 21 trillion and planning to have monthly purchases by March of 2026. With the biggest buyers stepping back, the private market must absorb the flood of new debt at a much higher yield. Now, traditional domestic buyers are on strike. Life insurances, normally the second largest holders of JDBs, cut positions by 1.35 trillion in the first quarter, the steepest pullback since 2017, citing rate volatility and uncertainty over the BOJ's hiking path. As well, sticky inflation keeps the BOJ boxed in. The core CPI has stayed a little bit around 3% for 7 months, while above the 2% target. If it stays hot, the BOJ will have to hike again in quarter 3, adding further upward pressure along the long yield curve. So bond vigilantes are smelling blood, and the sell-off is feeding on itself. Commentators warn that consistently increasing spending and debt loads increase to stagnation and a bond rot, and that is not exactly what the market is currently want to be testing. Spillovers are already visible globally. The May-July surge in 30-year JDB yields narrowed the U.S.-Japan spread by 40 bips, jolting long-dated U.S. and German yields higher and threatening to unwind the yen-funded carry trades as well. Near-term debt risk looks manageable, but the long game is ugly. Fitch notes inflation is temporary, helping the debt-to-GDP ratio drift lower, yet aging costs, defense outlays, and higher interest expenses will push the trajectory up by the late 2020s, leaving Japan with the world's heftiest debt burden. So what's the big picture? Why are yields spiking? The election-driven fiscal promises, plus the BOJ exit from bond buying, plus the fleeing domestic buyers, plus the persistent inflation equals investors demand a higher risk premium. Now, why matters outside of Japan? Rising JGB yields set a floor under the global long bond rates, threatening to yank money out of the U.S.-EU bond markets and could force a messy unwind of yen carry trades, and this could be theoretically tightening financial conditions worldwide. So here's some more key dates and timelines for you today. It is the 15th. On the 17th is the June national CPI. A hot print could cement the Bank of Japan's rank heights. Within July 20th, the upper house election surprise loss for the ruling bloc could trigger further sell-offs. Late June to August is BOJ's meeting and the QT pace update. Any hint of reacceleration will cause tightening, causing more further upward pressures on the yields. Q3, Q4 is life insurers are allocating plans. If insurers are stay on the sideline, the demand gap choose to widen. Bottom line, Japan's safe bond market just reminded everyone that even the lowest yielding sovereign debt can bite when it comes to politics, policy reversal, and a demographic collapse. And well, it sounds like it's going to be a very fun time, and well, maybe we should be buying some of those bonds too.